Well, good morning, Southern Oregon, and welcome to the Real Estate Show. I'm Alice Lima here with my co-host, Pete Belcastro. We're both brokers here at John L. Scott in Southern Oregon. And here we are. It's middle of June, almost the middle of June. Not much rain, not much water, and not very many houses for sale yet. What do you think, Pete?
Well, you're right about the water situation. It's bleak, and it's really sad. I mean, to be honest, and how we deal with it is going to say a lot about our community in the future. It's going to affect real estate at some point. We don't know yet, but it's going to. But right now, Alice, as we start into some of the summer selling season is underway, there are more inventory, more homes are coming on the market. They're still selling fast. We're still seeing multiple offers in the lower price ranges and even some of the upper ranges. There's still a ton of luxury homes for sale. And I don't know if it's plateaued or not. It seems like maybe it has a little bit, but still it's a robust market. And so today on our show, what's interesting is that, look, if interest rates stay where they are, and you and I have both refinanced and done this here in the last few months, if they stay the way they are, the real estate market is going to continue to churn, and it's going to produce, more and more cost and things like that. So it's got to slow down at some point because we grew by 24% prices a year ago in Jackson County alone.
Can you believe that?
Sustainable, but that's the reality of the market we're in. So we as buyers and sellers have to be prepared of what to expect. And so Giles Michael Ronchetti from Mutual of Omaha Mortgage is going to join us today to talk about that very thing. How do we prepare for lending in this kind of a market?
Well, and also I want to remind people that the two spikes that we had in prices driven by the COVID and then by the fires, those, even though the prices did go up, those were artificial events, so to speak. They were not economically driven per se. They were reactionary. And so both you and I, Pete, have been waiting for more listings to come on, for people to feel confident about selling, feel confident that they could find another place to go and watch those listings start coming. We've been waiting for that quote tsunami of listings. And I'm thinking this week, last week, and the week before, the last 3 weeks, we're starting to get enough more listings. Maybe the housing drought is over.
But we'll find out, because again, the biggest impediment has been, as you just said it, replacement property. Where do I go if I sell, if I move up, if I downsize, right size? Where do I go? And that has been such a problem for months and months and months now. And that really is going to be the key to changing our market. But right now, it's still higher end market. Most of the market takes place below 500,000, yet most of the listings, it seems like, are above that. So crazy market as we see, but somehow we get through it. We'll learn more about it today.
Well, we've got a great show for you, so stay tuned. This is Alice Lima and Pete Belcastro. We're brought to you by Mutual of Omaha Mortgage, Giles, Rogue Valley Association Realtors, and our very own John L. Scott, Southern Oregon. Do not touch that dial. Well, welcome back, Southern Oregon, to the Real Estate Show. I'm Alice Lima here with my co-host, Pete Belcastro. We're both brokers here in Southern Oregon for John L. Scott Real Estate. And we're so fortunate today to have our sponsors with us. This is Giles, Mutual of Omaha Mortgage, and his area sales manager, Michael Ronchetti. Welcome, gentlemen.
Hey, thanks. We're still kind of plugging along. Every time I think that this whole season will end with everybody being so busy, it just keeps on going. So here we are again. Thanks for having us.
Well, here we are in the second week of June, and things are definitely changing in the market. It's still a tight market. How are the interest rates, and how are the buyers dealing with the high demand on you guys' end?
Oh man, I think probably the biggest thing is, I think everybody's at the understanding now as a buyer that don't go in and ask for the world. You really need to lean on a good real estate agent to know what you can and can't offer on a house. So that's the main thing that I'm seeing with people that are actually getting houses accepted are realistic buyers that are willing to go in and not try to lowball, not try to ask for a whole bunch of things that really aren't going to happen. So multiple offers, which you guys are seeing. So it's just all about kind of putting your best foot forward and coming in with a good, strong offer. But I have had actually 4 or 5 new ones in the last couple of days. So I don't know, somehow they're kind of figuring out how to meet in the middle, and we're getting some accepted.
Well, and I think it helps that we have a few more listings coming on, don't you think, Pete?
Well, there are more listings coming on. There's no question about that, which I think is really good for the market. And I'm talking about listings below that 500,000 range. You know, right now, last week, when those stats came out for the previous 3 months, Guy and Michael, this is what we saw in Jackson County. We saw a 24% rise in prices from a year ago in the last 3 months. That is astonishing, and that is really high for us here. And that is really very, very much an unsustainable kind of figure to meet. And so what does that mean for us in the future going forward here? Because prices, you can't squeeze you can't squeeze a turnip or something out of us, whatever it is. You can only get so much for a price of a house. And I wonder if we've plateaued or anything, or what you guys are seeing in this, because the market price rise has really risen more than we can really sustain.
Yeah, I mean, I think probably Mike's been dealing with that up in the Seattle area a little bit longer than I have, but I'm definitely seeing offers where literally nobody even thinks that the house is going to hit that value. So they're writing it right into the offer that, hey, I'll come up with an extra $30,000 if this thing doesn't appraise where it needs to for this. So, I mean, yeah, we're kind of beyond the sustainable place, at least for the regular guy. I mean, we've had so many people moving in here from out of the area, getting good medical jobs and things like that. They're able to sell their house in California or someplace and have a decent enough down payment to do it. But it's definitely squeezed some of the local people around, or some of the people that aren't independently wealthy that are moving here.
Yeah.
Yeah. What we're trying to do too is mitigate a lot of that too, Pete, with taking a lot of the programs that are out there, getting full underwritten approvals for folks that are going out and looking, so that we can really try to put together, they can be more strategic with the offers and getting with yourself and putting in strategic offers by knowing, all right, in case of an escalation and going in over value, these are the options that we have from a lending side, because we have that borrower fully approved, not just kind of pre-qual look at their credit, but through underwriting and knowing that here are our options, here's the assets, and here's what we can work with strategically to look to win those offers in a market we haven't seen before.
So what does that mean if I come to Guy today and I want just what you're talking about, that kind of an approval? It's different from what we're normally been doing, or tell me how the difference is or what we should look for, or what buyers should then ask for. I'm not sure.
In the past, there's been a lot of more focus on credit approvals or quick underwrite looks. Now we're doing literally to the point where we just, if an appraisal, purchase contract, and title, and we're basically resubmitting for a final close. Where so we're doing a full income asset look, not just having an underwriter look at credit and recent pay stubs, but we're getting a full approval with the only missing item being the house, the title, and the purchase contract that's correlating with it. But having all that asset really does open up and allow us to look, what type of programs we can do in case of escalations.
Yeah, I mean, so the difference would be if you went in on Quicken Loans' website and plugged in your information, and you're a rocket scientist and you make $900,000 a month. They may or may not verify that. We're actually going in, we're keeping our regular turn times for our underwriting. So somebody comes in here, they get pre-qualified. I'm collecting all their documentation, getting it in front of an underwriter. So 24 to 48 hours is what our turnaround times are for underwriting. They're fully credit approving these people. So if somebody else has a pre-qualification letter, it's going to be different than a full credit approval. So I think that's going to really set the real estate agents that we work with apart, and hopefully help with getting some offers accepted. So,
when the seller takes that offer, they know it's going to go through. Sorry, Pete, go ahead.
I was going to say, in this market right now, we're seeing multiples and the kinds of loans. I've never seen where the sellers are taking an active role and are commenting about what type of loan the buyers are presenting to them. So when you have multiple offers and you're seeing, 4 or 5 different loans, the sellers are drilling down to seeing what kind of loan it is, and et cetera, et cetera, et cetera. And I would think, Alice, do you agree with this? From what I've heard from Guy and Michael, is that this is a different type of pre-approval where you're all ready to go. That's already done. In other words, that process is eliminated already up front.
Well, and it also means, how so many of these go into escalation, as Michael was saying. Then as a buyer, you can still compete. And when you write that next level of counteroffer or highest and best response to the multiple offer addendum, that it's going to go through, and the seller knows it's going to go through, because the sellers are really nervous. There's nothing worse than having 5 offers on your property in the first week, and then you take one, and then 3 weeks later, the buyer fails. And that happens a lot.
Mm-hmm.
So, historically, we've been able to do these sort of things, but they just kind of take kind of a back burner where, the underwriters do them as they have time. But these literally are first in, first out, just like our purchases, and our purchases aren't suffering from it at all. We just have the capacity to be able to do this. So it's just a better feeling, going in. It's a decent feeling to go get online and know that you're pre-approved, but it's a really good feeling to know that the underwriter's already looked at it, and that's the underwriter that'll be taking a look at it later on. So barring something going crazy with the house, your deal's going to close, and it's going to be faster because that piece is.
What type of documents, Guy, do we need to bring in? Do buyers need to bring for this to get this done fast like this? What do they need to do?
You want to go, Mike? I've been talking a lot.
It is the standard income documentation. So, while we have gotten much more aggressive with trying to go more limited, but it's having the recent pay stubs last 30 days, last year's W-2 for those that are W-2, if you're business for self, at least having those last year tax returns, and any of the assets that you have. I think a lot of people don't even realize 401ks, all these things will add up to assets or ability to go. But some folks just think of what you have in your bank account, but there's other things to gather. And it allows us, the more we can get, the more we can really see, the options. And that's really what we're looking to give our borrowers is, and working with the realtors, is options on the fly. So if something happens, not everything goes in the offer process like we all hope. So we want to be able to come back and say, okay, that's great, but here's what we got. And if you will, plan B on everything we're looking at. We can do that with these type of approvals because we have it all in front of us.
Mm-hmm.
I'm curious, for the jumbo loans are over 400 and something thousand. Is that the new limit? I'm just curious. I wanted to ask kind of, because we're seeing so many more expensive real properties be sold lately. I was wondering if you guys are seeing an increase in your jumbo loan applications.
Down here, our number is $548,258 or $250. So just a hair under $550,000 is what puts us into what's called the jumbo. And yeah, we are seeing a lot more of those bigger ones. You're usually looking at about 10% down for one of those. There are some 5%. Look at, a bunch of different options with a first mortgage and a second mortgage, or just doing a jumbo loan. And that's why it's good to get these things in here, get all their documentation, and figure out which way is the best way to go on those. Because there's 3 or 4 different options that we've been using when you have those higher dollar amounts, just depending on the circumstances.
So we're seeing a lot of our market now, a 500,000 and above, guys, in our Jackson County still has $74 million properties listed at the moment, but they are selling. So tell people how that jumbo part works, because you've got so much money. You're basically getting 2 loans, right? When you do this type of a property.
It would depend on the circumstances. If we were doing a straight jumbo loan, meaning you have Freddie Mac and Fannie Mae, the big guys that you always hear about in the news. They're allowed to purchase loans up to that $548,000 mark. Anything above that is what's called a portfolio loan or a jumbo loan that a bank is just going to take on their own books. So it's not necessarily two loans. Sometimes we do what's called a first-second mortgage, where we'll do a first mortgage for this conforming loan amount. So we can get the best rates possible for that. And then we'll do like a 10% second mortgage and get people into the house that way. Or we can just look at doing a straight one loan, just depending on just the different variables within the one loan, the circumstances of it, whether or not it makes more sense to do two loans, do a first, second, or just one big jumbo loan. So
Alice, would you jumbo loan here one?
I'm sorry, can you say that again?
Have you ever done a jumbo loan or recommend those with clients much?
Yes, because that's really what you end up doing if you're financing to a large extent. That's what you end up doing in those more expensive properties. And I don't think people realize that it's a different loan product and you have different qualifications.
Yeah, well, it's also a larger price tag if you're financing a lot more of it, which runs up the price. And that's the thing that we talk about is you have money how do you want to spend your money? Do you want to lower monthly total? You want to put more down, or how do you want to do that? And I think jumbo loans is what we're hearing is certainly one way to do it, but it also comes with certain more risks, it sounds like, as well. I've never done one myself. I don't know if I would do one, but never gotten that high. But obviously there's a lot of people doing it. It was just guys just been saying.
Well, and we've got a break coming up. So stay with us, folks. We've got more educational information coming from Guy Giles and Michael Ronchetti, both of Mutual of Omaha Mortgage. We'll be right back. Do not touch that dial. Well, good morning again, folks. Alice Lima, Pete Belcastro. We're both brokers here at John L. Scott, Southern Oregon. Welcome back to the Real Estate Show. We have a lively conversation going with Guy Giles and Michael Ronchetti, both of Mutual of Omaha Mortgage. And they're also one of our sponsors, which we appreciate you folks very much. Right before the break, we were talking about jumbo loans and how in these higher priced properties, it's a different animal. And Pete had mentioned the expense are there more points, or is it a little more expensive to get one of those jumbo loans?
No, actually, it's jumbo loans in a lot of scenarios might be as low or even lower rate than standard conventional loans. The one thing about jumbo loans, you really want to make sure you're dealing with a mortgage professional like Guy, because there is, as I always say, there's not a lot of gray with jumbo. So you want to make sure you're working with a mortgage professional that is used to and has an experience with jumbo products. But because as far as the rate and price and fees, they're low. Now, we're lucky at Mutual of Omaha. We do a lot of different jumbo products in-house. We underwrite them in-house. There are a lot of other products, like Guy had mentioned earlier, higher loan to values that they're going now. They're doing a lot of unique things. There are some things that we can send out. So, and I think a lot of it is because of the marketplace that we're in right now. The housing market's doing well from a value. Of course, that comes with its own complications, but it also helps open up a lot of guidelines. And that's what we're seeing right now is lenders opening up in that area.
A big part of this whole, of the whole jumbo story is that it allows banks to attract clients that they may make some money on the mortgage, but they're really going to make a lot of their money on the investment products and things. So what we'll do is if we have somebody, a lot of these people that are buying these more expensive houses have a higher net worth, and the jumbo investors will come in and say, hey, we might give you a little bit lower rate, thinking that they'll move some money over, and then they can make some money through investments or different products that the bank offers. So believe it or not, they've actually been really, really competitive. They're starting to learn that there's more to it than maybe just servicing on one loan that they can get. So we've been really competitive on our jumbo stuff, and I've been pleasantly surprised for a lot of times on those.
So what if somebody comes to you and they're self-employed? What kind of a process do they go through in that circumstance?
A self-employed borrower, the one big thing there is the need for, if we're going jumbo, would be the need for a 2-year taxes to look back, and then they will look for an updated year to date, what they call profit loss. That would be something else that would have to be gathered for, and that's really honestly within the lending world today with conventional loans. There's really not much more that's really needed on a jumbo loan than a conventional for someone that has their own business or ownership of a company in over 25% ownership in. They are all still going to be requiring pretty much the same thing, whether it's conventional, jumbo, FHA, and so forth, which would be a 2-year tax returns, year-to-date profit loss coming in, unless you're doing some sort of unique what's known as non-QM bank statement type loan. Other than that, that's going to get you where we're looking for. Down payments and so forth, though, no different than if you're W-2.
Isn't that something? That's great, because we have a lot of self-employed people. Even after the corona, we still have a lot of businesses left. Yeah. And with these low rates, it's really interesting. I don't know, Pete, what you're seeing out there, but if people can get past the dollar amount that they're spending on the house and just focus on their payment, it's actually pretty comfortable. Are you seeing that out there, Pete?
Well, it depends on how much you want to go into payment, Alice. That's always the problem. And I think that's what lenders are there for, to help in that also, because how much do you want to make of a payment? And, in jumbo loans add to payments, they add to the cost. In smaller, more down payment doesn't. So it's really up to, I suppose, as Guy always says, each individual is different. My question, though, is regarding appraisals, because look, we can't be selling at 24% over a year and not have appraisals come in low, because again, appraisers look back 6 months at what has sold and not looking forward to what might sell in the future. So I'm curious as to how are you as lenders dealing with appraisals that come in, come in low? Because I'm sure we're having them. I mean, we're seeing a lot more of it. So how should people deal with that? And what should they do when they get into that situation? Whether you're in for a jumbo loan or a smaller loan, how should they deal with that? And what are your options?
One of the big things, luckily we're in far enough into what's going on in the housing world with values increasing, and Pete, to your point about the 24%, a lot of the appraisers are now able for purchases. Refinancing is a lot different. Refinancing will look back that 6-month trend and 90-day trend. On the purchases, appraisers are giving a little bit more latitude as to taking in what the market is currently doing. So we're seeing appraisers look to start getting more more aggressive now in the Washington market, up in Seattle area. It's a little bit different because the escalations are outlying even the aggressiveness of the appraisals, and you're seeing those short appraisals, and folks are having to bring in those funds. In Oregon and Medford specifically, we're seeing values coming in now a little bit more. We're seeing appraisers get more aggressive on noting what the market's doing, taking in consideration, that 24% that you mentioned earlier, and getting more aggressive. But that also goes back to us putting together a plan B and C for what if the value's short, and looking and having a complete analysis of our borrowers and knowing exactly what's going on with them and what they're willing to do. Because to your point and Guy's point, every borrower is different, and we have to be able to know what to do on the turn in the event.
A lot of times what we can look at doing also, if you're a little bit short, say you're putting 10% down on a conventional loan and you have mortgage insurance, and we come in a little bit light on the appraisal, we can just alter the loan to value a little bit, as far as giving them a little bit, a few more dollars in mortgage insurance, and absorb the cost of that appraisal coming in a little bit low. So it'll change their terms a little bit, maybe, a few dollars more a month for their mortgage insurance. Usually it's not a lot, but we can change within 5% of each other. So if you have a 10% down loan, really nothing's going to change a lot. If you have 12% down, or pardon me, an 88% loan to value rather than a 90% loan to value. So we're actually getting pretty creative with the mortgage insurance when these things come in low. And a lot of times you can absorb that. Really, there's no harm or foul to the person. It's really not making a material change with what they're actually paying.
What about non-appraisal loans? I've seen somewhere the lender has said we're waiving the appraisal.
I believe it's about 40% right now.
You ever done that, or what's going on with that?
It's probably happening about 40% of the time was the last time that I looked.
That's high.
We're getting a ton of them. Yeah, there's starting to be a little bit of pushback from the CFPB. I've been reading a little bit where they're trying to tone those down a little bit. Not like appraisers have any capacity right now as it is, but we are still seeing a lot of them, and we actually run everybody, Freddie Mac and Fannie Mae, and we play around with these a little bit, and we try to get appraisal waivers when we can.
So how do you guys decide who gets an appraisal waiver? Like what's the process for that?
It just depends on, how much money they give us on the back end. I'm just totally teasing. I should never say that on the radio.
You should never say that. He's just kidding, folks.
So honestly, it's a little arbitrary, but I think a lot of it has to do with if Fannie Mae already held a loan on a house, or there's been a whole lot of loans that have properties have sold in a particular neighborhood. It can just, from the computer, it can generate, hey, you know what, we can see that 1,700 square feet right here in this neighborhood, a lot of them have sold for this. There's been a lot of actual appraisals. So the computer just kind of knows when to spit them out and when not to. And it, like I said, it feels a little arbitrary, but it's
an analytics.
It is.
That's
interesting. So with Fannie Mae, Freddie Mac, the DU or LP, what's known as the automated underwriting system, behind it has a valuation, automated value system, and it's based upon if you're running DU or Fannie Mae stuff, it's based on the homes of Fannie Mae, as Guy mentioned, in an area, and they will give a variance. And if the valuation of the purchase contract is within that tolerance, that variance, then it will issue what's known as a PIW or an appraisal waiver. And they're getting obviously more and more properties in every community out there, which is why we're seeing a lot more waivers historically and on purchases than what we have in the past.
So does it have much to do with the borrower then, the buyer and their credit?
A little bit, yes. There is certain things like loan to value on the file, because it will, if it starts to hit or push that, if you will, tolerance or variance of value, then it will look at the borrower. Good FICO scores, low loan to values, assets. Why it's always important to get assets or give assets on all files, because these are the things that will help maybe give a little bit, because we have seen waivers lost, because we had to raise the loan to value of the file, raise the loan amount. So there are things that do come in consideration with that.
So is there any automatic, is there something that you can tell us that we can send out to the general public? If you do this, this, and this, you will automatically be, your appraisal will be waived, or is it really that individual?
It's really that individual. I wish it was that easy to say that if you get this house and this is the value, this or less, we're gonna get a waiver. It's really hard to do that because there are other factors than just the value of what may be Fannie or Freddie, and of course they're not telling us that magic number either. Okay,
so you can't tell somebody if you put 40% down, you're not going to have to do an appraisal. It's that magic combination.
Right.
I see.
Yes. Unfortunately, no.
Alice, I had a good comment where we were in Lakeview and the appraiser wanted $3,200. One appraiser wanted $3,200 to come and do this house. And the lender actually said, we're going to do an appraisal waiver on that property. Which was
wow, that's bold.
I know we got a break coming up, but when we come back, I'd like to ask these guys about the types of loans that people are getting today.
Mhm.
What ones that are working and what should we avoid? Because that's such a big thing for buyers to the type of loan you get. So I'm curious what they're going to say when we come back on that.
Okay, so folks, stay tuned. Alice Lima, Pete Belcastro. We'll be right back with the Real Estate Show. We're talking to Guy Giles and Michael Ronchetti, Mutual of Omaha Mortgage. So stay tuned. Well, welcome back to the Real Estate Show, folks. Alice Lima here with my co-host, Pete Belcastro. We're both real estate brokers here in Southern Oregon with John L. Scott. And we're talking to Guy Giles and his area sales manager with Mutual of Omaha Mortgage. And Pete, you had a question right before the break. You wanted to talk about different kinds of loans and how what the general public was doing as far as which type of loans they were asking for.
I do, but before I do that, I do want to ask Michael one thing because he sees a different market. When we talk about our market here in Jackson County, Josephine, Klamath, what's going on, seeing that. Michael, you're up in the Puget Sound area. Just give us a brief description. You told me that people are leaving the city, they're going into the suburbs, and now they're leaving further into small towns. So it's escalating. Tell us what's going on up there, because to give us a perception about how our market is, to compare it.
Well, a few of the things. One is you do have a lot of folks leaving the city, and they're taking a large equity position out of a home that they're leaving, in or around the greater Seattle proper, if you will, and they're moving out. But now because of one thing, a lot of different tech companies specifically learned is that you don't have to be a mile away from work anymore. You can actually be 50 miles away from work. So they're pushing out into the rural areas, not just the burbs, if you will, of yesteryear. They're really pushing out, which is putting a big damper on the local or those markets that historically have been a lot less. It's pushing up the escalations now on those properties, creating a very tight marketplace. And so we're seeing, as everybody is really seeing a lot of that escalation going on. And they're just, it's no longer just the Bellevues and the Redmonds and the Issaquahs and the Sammamish, it's now people going up in Cedral Woolley and Marysville and all these different areas, and which in the past were very lower cost, 300,000 folks could go in, and now, not so much. But we do, if there is a saving grace, they do have high cost limits in several of the counties up here that go up to and into the 760,000 range with conventional lending, which helps.
Well, we have a lot of the same stuff here, but small towns in Oregon, rural small towns don't have housing anyway to start with. And when the pressure to buy these things, and again, rural communities, the gentrification is just going to continue, and it's just going to upset more and more people as this happens. We're seeing it happen in our small towns in Southern Oregon. They're very popular. There's no housing to begin with, and now people are being pushed out even further. It's really sad, and I don't know if that's even being addressed. But beyond that, let me ask Guy, what loan today? I mean, I'm seeing people, if you want an FHA loan or a USDA loan, even a VA loan for many instances, it may not get you what you want. That it seems like buyers are only accepting conventional loans in most instances, not all. But what are you writing today, Guy, that we should know about that people are doing?
Well, it's just, I've talked about it in the past. Really, the mortgage insurance has come a long way. Sometimes I'm seeing mortgage insurance as low as, $23, $27 a month. And I'm talking about on conventional loans. So my heart is always to put people in conventional loans. I took a glance at my pipeline when, right before the break, when you said you were going to talk about what kinds of loans people are doing. I would say I'm probably 75, 80% conventional loans. I'm getting a ton of people that are first-time home buyers that are kind of ready to buy. Believe it or not, they never really would have gone down that road maybe, but they're having trouble finding places to rent. So they're just kind of coming in and seeing me, and we're figuring out that between either gifts from family or money they have saved, they actually have enough to buy a house. And that's probably 3 of the 4 contracts, the last ones that I've got. So really it's more conventional than anything. I've always historically done a ton of VA loans. FHAs, it's just that mortgage insurance forever, unless you have a poor credit score or something. I really try to put people into something that's a little bit more traditional, because we just don't know how long rates are going to be low like they are right now. And if you can lock somebody in and not have it a foregone conclusion if they're just going to refinance in 6 months, that's never my heart to get you in a loan program, knowing that I'm going to get you into another loan program a couple months down the road. If I can do the right one now, that's really what I'm going to try to do. Not that I don't want to do repeat business. I do a lot of it, but never by design from the first day. So I tend to see a lot of conventionals.
What are the credit score limits for FHA versus conventional? Do you have a range?
The main thing is, like on conventional loans, I don't think we have technically a minimum FICO score right now, as long as we get an approval. That said, if I had a 622 credit score on a conventional loan, your mortgage insurance is going to cost more than your car. So, when I talk about reasonable mortgage insurance, I'm usually talking about, somebody with a good credit score. If you don't, then we're talking about FHA. So it doesn't come down to necessarily what you can or can't do. The conforming or Fannie Mae, Freddie Mac loans, they just make it really, really unattractive if you have a poor credit score. So at that point, that's when you really start looking at the FHA loans, just because that mortgage insurance, it's capped at a certain amount, whether you have an 800 credit score or a 620 credit score. So, they are pretty credit driven. But, like I said, it's really on the just circumstances of whatever the borrower is doing. So,
I just wanted to add in there, because of what we're seeing with the values too, and especially in a lot of these smaller community counties, with folks moving out and pushing up these values. FHA has not caught up with their minimal or maximum loan sizes for each of the counties. They have great around Portland, but not so much, out in Jackson County and so forth. So they really haven't caught up, and that's why I think conventional lending is still one of the best ways to go, unless, to Guy's point, there's credit issues.
And one last point that I want to make here while you guys are here, Alice, I don't know if you do this, but I tell buyers now that when we talk about lenders and what to do, and I tell them we're not working with online lenders, and we're not working with out-of-state lenders anymore, because in my experience with it, sellers are not even accepting those. They have the choice, especially if they have multiple offers. And so I just tell people we're working with local lenders, people like Guy, who we can get across the table with, rather than going on online. And so because sellers are dictating this. It isn't coming from me, the realtor. It's coming from sellers who are rejecting offers that we've submitted, who are from out-of-state lenders or online lenders they don't want to deal with.
Well, and they've heard stories from their friends and their family. And so, we're in a small community here, and word spreads really fast if something goes sideways, and they put it on the neighborhood app, So I think people are educated more about what happens if your buyer has a lender that's not as good.
Yeah, and I really do like, Guy and Michael, the pre-approval process that you're going through now. I think that will help buyers to have that additional underwriting done when you're presenting those offers to a seller. So I think that's a good move. I hope that's going to be very successful.
Absolutely, I agree.
Well, we're just about out of time. Oops, sorry. What do you want to say?
I was going to say, being full credit approved, then all of a sudden we have that property addressed and we plug it in and we get a waiver on it. Now we're looking at a really fast close.
Wow.
So,
that's good.
Yeah, we didn't even get to talk about that. So next time we'll talk about that. Thank you, gentlemen. Guy Giles, Michael Ronchetti, Mutual of Omaha Mortgage. We appreciate you so much. This is Alice Lima and Pete Belcastro saying have a beautiful Southern Oregon weekend. This broadcast will repeat tomorrow at 6 p.m. We'll see you next week. Bye now.